Welcome to this video on homeowners insurance deductibles. $1,000 versus $2,500 versus $5,000, and what you really pay when you file a claim. If you have ever looked at your policy and wondered why the deductible matters so much, or why the premium changes when you pick a higher deductible, this is for you. We will go step by step. We will use clear numbers, we will run multiple claim examples, and we will talk about the trade-offs that matter in real life. By the end, you should be able to choose a deductible that fits your budget, your emergency savings, your risk tolerance, and the way you would actually use insurance. First, a quick grounding idea. Homeowners insurance is designed to protect you from financially painful events, not from every minor repair. The deductible is the part you agree to pay out of pocket before the insurer pays the rest in a covered claim. You can think of it like the entry fee you pay to access the larger protection of the policy. The deductible shifts some of the risk back to you, and because you are taking on more risk when the deductible is higher, the premium usually goes down. But what you really pay is not only the deductible. In a real claim, your out-of-pocket amount can include your deductible, plus anything that is not covered, plus any amount above your coverage limits, plus any depreciation or special settlement rules, plus the time and hassle costs that are not on a spreadsheet. This video focuses mainly on the deductible, but we will keep reminding you about the other pieces because they matter when people are surprised after a loss. Now let us define the three deductibles we are comparing: $1,000, $2,500, and $5,000. These are common fixed dollar deductibles. Some policies also have percentage deductibles, especially for wind or hurricane, that work differently because they are based on the insured value of the home. If your policy uses a percentage deductible for certain perils, you should treat that as a separate layer and do similar math. For today, we are focusing on a simple fixed deductible comparison because it is the most straightforward way to understand the real payment mechanics. Here is the basic claim math for a covered loss. Covered loss amount minus your deductible equals the insurer payment, subject to limits and settlement rules. Your minimum out-of-pocket is usually the deductible, assuming the loss is fully covered and within limits. If the loss is smaller than the deductible, you pay the whole thing and the insurer pays zero. That is a crucial point because it is why the deductible changes whether a claim is even worth filing. So let us run some numbers. We will use a handful of claim sizes that resemble common homeowner situations. A small water damage repair that costs $1,500. A moderate loss that costs $4,000. A larger loss that costs $12,000. And a big event that costs $50,000. These are round numbers, but they illustrate exactly how the deductible changes your cost. Example 1, $1,500 covered loss. With a $1,000 deductible, you pay $1,000, the insurer pays $500. With the $2,500 deductible, you pay $1,500, the insurer pays zero, because the deductible exceeds the loss. With a $5,000 deductible, you pay $1,500, insurer pays zero. In this small claim scenario, the difference between $1,000 and $2,500 is not $1,500. It is the entire decision of whether insurance contributes at all. Example 2, $4,000 covered loss. With a $1,000 deductible, you pay $1,000, insurer pays $3,000. With the $2,500 deductible, you pay $2,500, insurer pays $1,500. With a $5,000 deductible, you pay $4,000, insurer pays zero. Again, the $5,000 deductible turns this into a self-funded event, while the $1,000 deductible turns it into a meaningful insurance claim. Example 3. $12,000 covered loss. With a $1,000 deductible, you pay $1,000, insurer pays $11,000. With the $2,500 deductible, you pay $2,500, insurer pays $9,500. With the $5,000 deductible, you pay $5,000, insurer pays $7,000. Here, the insurer payment is substantial in all three cases, but your out-of-pocket jumps by $1,500, between $1,000 and $2,500, and jumps by another $2,500 between $2,500 and $5,000. Example for $50,000 covered loss. With a $1,000 deductible, you pay $1,000, insurer pays $49,000. With the $2,500 deductible, you pay $2,500, insurer pays $47,500. With a $5,000 deductible, you pay $5,000, insurer pays $45,000. In a big claim, the deductible is still real money, but it is a relatively small share of the loss. That is why insurance is most valuable for larger events, and why many people prefer higher deductibles if they can comfortably absorb them. So far this seems simple. Higher deductible means more out-of-pocket when you claim, and less premium each year. The real decision is whether the premium savings are worth the additional out-of-pocket risk, and whether you will actually file claims of various sizes. That requires thinking in scenarios, not just in one average number. Let us talk about the premium side. Insurers price policies based on expected losses and administrative costs. When you choose the higher deductible, you reduce the number of small claims you will file, and you reduce the expected payout on many claims so that insurer can charge less. How much less depends on your location, the age of the home, construction, prior losses, credit-based insurance score in many jurisdictions, and the insurer. But we can still model the decision with your own quotes. Here is a practical method. Ask your insurer or agent to quote the premium at each deductible level, $1,000, $2,500, $5,000, with the same coverage and endorsements. Then calculate the annual savings when you go up in deductible. Then compute a break-even time for the added deductible exposure. Let us do an example with plausible numbers. Suppose at $1,000 deductible your premium is $2,400 per year. At $2,500 deductible, it drops to $2,100 per year. At $5,000 deductible, it drops to $1,900 per year. That means you save $300 per year, going from $1,000 to $2,500, and you save $500 per year, going from $1,000 to $5,000, and you save $200 per year, going from $2,500 to $5,000. Now compare those savings to the added out-of-pocket in a claim. If you move from $1,000 to $2,500, you are taking on an extra $1,500 of deductible. If you save $300 per year, it takes 5 years of savings to equal that extra $1,500. If you move from $1,000 to $5,000, you are taking on an extra $4,000 of deductible. If you save $500 per year, it takes 8 years of savings to equal $4,000. If you move from $2,500 to $5,000, you take on an extra $2,500 and save $200 per year. That is 12.5 years to equal the extra deductible. This is not a perfect decision rule, but it is a strong starting point. If you would be upset paying the higher deductible in year 1, but you would need 8 years of savings to offset it, that suggests you might be buying a premium discount with risk you cannot comfortably carry. On the other hand, if you have strong emergency savings and you plan to stay in the home for a long time, a higher deductible may be economically sensible. But there is a second layer that people often miss. The decision is not only about one claim. It is also about claim frequency. and the impact of filing claims on your future premiums and insurability.